Hello, everyone, and welcome to the 2018 REIG Real Estate Investment Group State of the Market Address and Real Estate Market Outlook. Hi, everyone. I'm Gio Reedus. I am the Executive Director of our team, and it has been a very interesting 2017. And our 2017 State of the Market Address was quite accurate. We are now looking forward to the year ahead and are seeing quite a lot on the plate for this coming year for real estate, both locally and nationwide. And as our motto has always been, we do real estate by the numbers, let's start first by looking at the raw data and statistics. See, the Case-Shiller Index showed that Las Vegas in 2017 was the second fastest growing real estate market in the country. Local home prices were 9% year over year, using September as a bellwether. From the same source, new home builder sales reached a record median of $356,400 towards the end of 2017. Now, this is an often overlooked and undervalued indicator. That is, it's important to consider when forecasting future sale prices of standing inventory, also known as existing home sales, and these are all the houses that are everything that is not new construction. So here's how it works, so that we can all understand it. And also keep in mind that we're using track home builders, not custom home builders, as the baseline, so it's more accurate. The cost of building a new home is determined by a set of elements that include the cost of building materials, such as copper wire for the electrical, lumber and aluminum for the frame, labor costs, costs of the workers who are building a property, fixed costs such as costs of doing business, licenses, insurance, etc. Now, these are all factored in when calculating the cost of building a new home. Then builders will add on top of that their profit. Now, this calculation then creates a new base that determines the cost average of building a new house. When the cost of building a new house rises, then the cost of all of the remaining standing inventory also tends to rise, with some exceptions. Because the cost and value of a property in order to rebuild it would be higher than the cost of the house as it stands. For those of you that already read my recent article about the 7 things you need to know before buying a house in 2018, you saw that we mentioned the importance of a great insurance agent or broker, and that plays in here. An insurance agent who knows what they're doing is a valuable resource to have as a home buyer, whether you're buying it to live in it or whether you're an investor, because we get many insights into the ancillary industry of insurance, which is also an indicator that we consider when calculating future home values. Insured values will rise as a result of this phenomenon, further supporting the increased price of homes relative to the baseline. Now, according to the GLVAR, which is the Greater Las Vegas Association of Realtors, the median sales prices for resales in Las Vegas, especially single-family houses, has more than doubled from the market bottom in 2012. This is attributed mainly to a couple of factors. First, the amount of cash buyers that have come into our market and purchased properties at high rates, mainly for the purpose of rentals, and the increasingly low inventory, which is the supply of properties available. Now, see, some people interpret this set of statistics as the formation of a market bubble. However, this is an inaccurate assessment of these facts, because it omits the statistics from the market bottom during the 2007 to 2012 periods. It's important to understand that the majority of the quote-unquote experts in the fields today did not live and work in the industry 10 years ago, and many have little recollection of the instances that occurred in Las Vegas during that time, and the severity of the impact of the crash that we here in Las Vegas felt. Now, myself, I recall it vividly, and I can still remember where I was the day of the 1,000-point flash crash that occurred in the stock markets. Many believe that this was the first indicator that something was about to happen in the markets. Many believe this was the first indicator that something was about to happen, which was soon followed by the major investment banks, the ones that all had the securitized mortgages backing their shares, like Lehman Brothers and Bear Stearns, only to name a few, that started to fall apart after 100 years of business in a matter of days. I also vividly remember the 3 separate sets of TARP programs that George W. Bush and Congress instated at that time, whose purpose was to bail out the quote-unquote too-big-to-fail businesses spearheaded by AIG, which was insuring all of the bank's non-performing assets, subprime mortgages, and credit default swaps, all of which were only beginning signs, which actually started in 2005, if you were paying attention, to the underlying housing market crisis that was about to burst. It's worth a quick read on the AIG Wikipedia page if you're interested, if you'd like a brief but accurate history of that incident. So what does all this have to do with housing market prices, and why are we still having a long way to go up before we see any kind of a pullback in Las Vegas real estate housing prices? Well, the answer is twofold. First, I guess that my point really is that many people have short memories, and in this particular respect, they have forgotten exactly how hard the Las Vegas market got hit. Or maybe it's more that the people do not truly understand the relationship between the pricing hit here in Vegas compared to the rest of the country. And second, it's important to understand what happened during that time, along with the TARP 1, 2, and 3 bailout tranches, so that you can see the correlation and understand the timing of the bank lending statuses, all of which I'll explain right now. In the past 4 months, we've also seen the FHA and the Fannie Mae raise their limits. Limits for FHA now allow for a purchase price of up to $305,000, and Fannie Mae limits now are considerably over $400,000. This is another often overlooked and under-discussed element that dramatically points to an overall consensus that home values, which are already rising, are going to continue to rise. If you consider that the average home price in Las Vegas, which has now risen to over $250,000, is still well below the FHA limit and extremely below the Fannie Mae limit, it shows that there's a long way to go in prices before the average home prices here begin to reach the Federal Housing Administration's limit. So why is this important? Well, let's break each of them down. FHA is the loan that is the easiest and most convenient for the massive populations to obtain. With more forgiving criteria, lower down payment required, typically 3.5%, lower FICO scores are allowed, this loan is specifically designed to help the average American obtain a loan for home ownership, which means that the average home for the average American is all of a sudden going to be more obtainable. That means more buyers in the market, which means that demand is going to go up. If you can even believe that it will go up more likely than more already than it already is. Now, with supply still extremely low, this will not negatively affect prices for the mid or long term. The short term, prices should continue to see above average sales and continued rising. And when inventory starts to come back into the marketplace, which we predict will occur over the first 2 quarters of 2018, price stability of these higher levels will be sustained. Another factor that we look at are the median days on the market, which have risen to 78 in most of the valley, while inventory is still low but very slowly building back. But prices are rising, a unique and strange matrix. So let's discuss this as a commodities conversation. In the commodities markets, we would say that new price floors have been established. And this is the most important part to take away from this article. Actually, to be more precise, new higher price floors have been established. When we compare these higher price floors to the average days on market and the average top-end price average of existing home sales, we see what is called a squeeze. Now, those of you who have pulled this up off of our website or that have seen our link, you can actually take a look at some of the charts that I've put into this. But those of you listening or watching on YouTube, you definitely want to check out those charts just so you can kind of see what I'm about to say. But I'll do my best to explain it. A squeeze is a term used to describe a rising price floor and either a falling or a stagnant price ceiling, which is exactly what we're seeing in the market as of the time of this printing, which is January 2018. This will, however, change, and how it will likely change is the price ceilings will go up. What is supporting this is not only the establishment of new higher limits in the aforementioned agencies raising their lending limits, but the subsequent complements of the banks and lending institutions creating new loan products in the marketplace. That, combined with the Federal Reserve wanting to see higher interest rates coming, provide the banks with the perfect environment to start to lend, and finally, the criteria that allows people to start to borrow. Now, as a result of this, we will finally see the top end of the market move up, widening the gap between low-end homes and high-end homes within the marketplace. This will also usher in a new era of investors in the fix and flip markets because the gap between properties that need work and properties that are completely finished and turnkey will also widen. Now, this shrunken gap between property conditions is why we have recently been seeing the average days on the market increase, even though we're in a market with historically low inventory. This is because people that own properties that are at the top end of the market have not yet seen enough rise in prices to justify the selling. There's no comps. So what the numbers and statistics are not showing us is the amount of homes that have sold that are in poor condition compared to the properties that are in great condition. My experience in the local market as an investor and the conversations and information that I get from my network confirm that the majority of the properties that have sold are properties that need work. This has been the major push in the bottom end of the market, which has pushed the price floor up. However, there has not been enough sales in many areas of the markets at the top end, condition-wise, to support a rise in those values, and sellers are holding on to their properties longer than they were even just 4 to 6 months ago. Now, this phenomenon, and it is a phenomenon, is going to change rather quickly in 2018, with Fannie Mae and the Federal Housing Association now lending on higher amounts. There will be more sold properties at the top end of the market, which will be able to be used as comps for loan appraised values to go through. This cycle will spur that squeeze that I mentioned earlier to expand, and we'll start seeing prices take off upward once again. Now, these items that I've just described are the fundamentals of where we are from a financial sense, as explained in commodities terms. Remember, the real estate market is the last supply and demand market on the planet, and it abides by almost all of the influencing factors that other widely traded commodity markets trade by. In addition, the housing market is intimately tied to the financial markets from the 2007 era housing crash, which I described above. The securitization of housing is still prevalent in the markets, and although they have now adapted to the new rules and regulations of oversight that was established by our government entities, housing is still being commoditized and traded in the marketplace as such. In fact, as a side note, it's likely that an even greater amount today is being traded in this securitized fashion than it was in the 2007 era, as a result of all the non-performing assets that the banks have held on to for the past 10 plus years, many of which have been converted from vacant homes into rental properties to create income-producing properties, sold off in large chunks as performing commodity portfolios. Now, these properties may or may not come back into the market as individual homes or as groups of homes at one time. This will depend on how much the market absorbs the properties as the year unfolds. Now, there's another core factor that we must consider in order for us to have completely considered the elements that make up the coming continued rise in prices, and that's the national average. Average home prices in the United States have continued to rise, and they continue to outpace the comeback that even Las Vegas is having. Let me try to explain this the best I can. The national average is so much higher than the average in Las Vegas that the Las Vegas market has a lot farther to go in order to catch up to just the average. Now, however, the national average is not stagnant. It's rising. So we have a national average that's rising and a local Las Vegas average that is rising, that are rising in tandem right now, which means that the gap between the two is basically staying the same, even though prices for both are rising simultaneously. Las Vegas is slowly catching up, however, but with the overall strength in the housing market in general, and with the price limits from FHA and Fannie Mae, the national agencies, the national average is also rising, and it's continuing to rise, it's going to continue to rise, which means that Las Vegas still has a large gap in prices to catch up to the national average. Now, the misconception that many people are having is the thought that Las Vegas is going to always lag below the national average, and that's simply not true. Before the crash, Las Vegas was outpacing the national average. Our forecast is that Las Vegas prices will return to an area that will be congruent with the national average at some point in the next 5 to 10 years. This means that gap, which is right now sitting around 28 to 35% range, will occur in the next 5 to 10 years, which, using 7 years as the target and amortizing the price gap over that time period, results in the average 4 to 5% year-over-year rise in prices in Las Vegas. Next, the new tax bill has passed, with incentives all over for real estate, capital gains, business tax, and mortgage interest, to name a few. The new tax bill gives us many reasons to get into or out of real estate. To check the details of the tax bill and how it may benefit you personally, contact your accountant or CPA. Also, value is high. Because you can still get a property for well less than the national average, it is a great time to take advantage of the still relatively low housing market prices here in Las Vegas and the still relatively low lending costs to get a loan. So overall, the Las Vegas market is healthy. With economy returning to the Strip and industry continuing to build, we see a litany of other influencing factors that contribute to the coming rise in prices. For more specific reasons on why Las Vegas is poised to blow up in prices, download our Home Know special report, and you can click on the link below, or you can visit our website at www.reiglv.com REIG.com to download it. So, what do we do now? These are the main influencing factors that we are seeing in combination, which is setting and supporting the current pattern of rising home prices in Las Vegas. So what can you do to take advantage of the market conditions that we're in? Well, the first thing you can do is prepare. Decide if you're wanting to buy or sell. Buyers, there's no better time in the coming 3 years to buy than right now. Prices will continue to rise. Sellers, if you've been sitting on a property wondering when is a good time to sell, now is the time. If you have a property that has a profit in it, it is a great time to sell. The tax benefits of the new tax bill will likely be very advantageous to you, and the market is still low in inventory, which means you will have many potential buyers in the pool. What we're seeing right now is another kind of an auction bidding situation that is going on for most sellers. You're getting multiple offers. A lot of it is cash and strong lending offers as well, so it's a great time to sell right now. Number 2 is take advantage of the market conditions. And this one goes hand in hand with number 4. The timing is right. The market conditions are advantageous, and the climate for making a move into or out of real estate is fantastic. Seeing the current indicators is important to understanding where we are. Knowing where we are currently is the most important thing, and hopefully I've done that with you so far today. Everything else is speculation. The only thing we know for sure is that we are currently in a market where it is advantageous to be in real estate, and there is never a bad time to take a profit or create a new opportunity for profit. Number 3 is to be realistic. Yes, prices are rising, but that doesn't mean that as a seller you can get whatever price you want and people will pay it. There's still rules to the market, and prices must be able to be supported by surrounding home comps. Now, as a seller, it's important that you realize that your house is valuable and inventory is low. There will likely be less haggling, and as long as you and your realtor have come to a realistic price that can be supported with market data, your house should sell rather quickly and for or at or near your list price. As a buyer, understand the market and understand the competition that exists right now. Cash is king, and a cash offer will likely beat out any other offer on the table, which means that if you're getting a loan and placing an offer, it's very likely that your offer will have to be at or near the list price of a home in order to get a house. Sellers right now are still being presented with an overwhelming amount of cash offers at or list price, and the negotiation is slim to none right now. Consider this when placing offers and looking at properties. We are not in the environment where a seller doesn't have a lot of options, so they need to negotiate on price and terms. If the price and terms are congruent with the market trend, then going with the flow is the only way to get the house. If you're a cash buyer, you have a slight advantage, but only just a slight one, because an offer from a buyer getting a loan is often strong right now because rising prices will support the appraisal. So be savvy, but not greedy when placing offers. The 4th thing you can do is pull the trigger. This is not the market to take a long time making a decision. A large majority of properties will get reasonable offers in the first 10 to 15 days of being on the market, depending on the time of year and holidays. This means that if you find a property that you like, be prepared to have your realtor write the offer the same day you see the property. This means you must have your ducks in a row and have your documentation signed, proof of funds or pre-qual letter in hand, and any other information you need prepared and ready to send. This is not the time for hesitation or double guessing. The average buyer's client right now in this market is writing 6 or more offers before even getting a property. So, in conclusion, everyone, we are in a pretty good spot in Las Vegas in real estate. There's a lot of factors that I'm not going to go through now, but feel free to either click on the YouTube channel and watch my 2017 State of the Market address, or go online to www.reiglv.com to download the special report where I detail out a lot of different factors. In fact, I believe there's 12 or 13 different factors that are affecting the Las Vegas market. And to be honest with you, the stadium coming in 2019 is on the last of the list. That's metaphorically speaking, of course, but it's only an icing on the cake to things that have already been going on and that are going on behind the scenes in the most part. The only reason that I'm able to know it is because I'm out there. My network is huge. I talk to a ton of people, and I actually go out and drive around, and I look, and I see, and I observe. It's a really, really good time to be in real estate right now in Las Vegas. There's a lot of different options. Some other things that I didn't mention in this report that are super hot are the high-rise condos. We've got our line on a couple of different condo projects out here, high-rises, and there's a lot of great properties that are available at really unbelievable prices. Prices that 3, 4, 5 years from now, we'll be looking back and saying, oh my gosh, I cannot believe that we could have ever found it that cheap. So it's a really good time. It's a great time to be prepared, be in real estate, whether you're looking to buy and hold, whether you're looking to buy and rent. Rents are starting to go up out here. It's just an all-around really good time to buy. Good time to sell, too, if you have a profit. But anyhow, I appreciate everybody sticking around for the entire 21 minutes. If anybody has any questions or needs to chat or wants to talk about anything in here, or if there's anything that I can do or my team can do for you for real estate, please don't hesitate to reach out. You can email me directly at gio, at reiglv.com. And feel free to call me at 702-805-2720.